Student investors, bonjour, this is Mike Yeru, founder of Dividend Stocks and passionate investor. Today I am super excited because in a few hours I'll be having a private webinar with my DSR members. So what we do at DSR is every month we pull out a webinar where we discuss market reviews and then I stick around to answer all their questions. So that kind of like feeling that you're missing with your advisor, we're kind of trying to give it at DSR. While we are not able to give buy and sell recommendations, we can at least guide people and give them ideas and share our thoughts about the stock market. So I thought that I would share with you a small market review today to give you an idea of where we're going right now and also to share a game plan. So obviously a game plan is a little bit longer, so I'll invite you to join a free webinar that will happen next week on Wednesday the 26th. Link is right below in the description. So here we go with this. So quick market review. Well, if you have been courageous over the past 6 months, you have been rewarded. Back in 2000, back at the beginning of the year, when the market crashes in March, we hosted weekly webinars for our DSR members, and we were telling them, you know what, this happens from time to time. It's another market crisis. You have to stay invested. Make sure that you look at your portfolio to make sure that you own solid companies, because obviously a lot of them got hurt. But in the meantime, if your portfolio was solid, you have seen a V recovery in your portfolio. I'm actually up since the beginning of the year. I haven't put money on the side. But the thing is, there's a big disconnect between what's happening on the stock market and what's happening in the economy. So there's no way right now that we're having a V recovery in the economy. So when we're talking about V recovery, is that we expect it goes from up there and then it goes down and then it goes back up right away. Right now we're more into kind of like swoosh recovery. So it's has recovered, but not too much. And the problem right now that we see is there's a lot of discrepancies between type of sectors. We have seen in this earnings season a lot of companies beating analyst expectations. And then you can ask, well, Mike, how can a company beat the expectations when they show sales down 30% or 28%? Well, the thing is, analysts were more pessimistic about that. They expected very low numbers. So in many cases, they expected minus 40 or minus 50. So when a company is saying, hey, you know what, we just lost a third of our business, well, they're thinking, well, it's not the end of the world. It's not that bad. We expected worse. So it's all about the difference between the expectation and the reality. Because if you ask me, losing a third of your business over a quarter, that's pretty bad. And it brings you to ask a little bit more question for what's coming after that, right? Oops, sorry. So what's happening is a lot of sectors are actually closing or will not be able to reopen. We're talking about restaurants, shopping, retailers, beauty and spas, bar, nightlife, fitness. So pretty much all the services that we have, and it's kind of funny because 50 years ago our economy was based on manufacture, so it was really industrial. And recession and market crisis always came from bad debts, so financial problems, or manufacturer problems, so oversupply, not having a strong demand for our products, and then we go into that recession where people lose their job because we're not manufacturing enough goods because people don't want to buy goods. But right now the thing is we have shifted this economy to a service economy. There's a lot of service that is being provided in person, and those ones are having a very hard time to reopen. And if they do, they will do it halfway or with like half of their employees. They will not offer the same service. And this is why what we see so far is the economy is reopening, but not as fast as we thought. So see on this graph, you clearly see where we had most of the economies at 100% back in January, February. Then March happens and then it drops suddenly by like 40, 50%, 60%, and then it goes back up smoothly. But we're kind of stuck at 80% of our economy in the best cases and at 60, 65 for the worst cases. So in other words, the economy is back in, but not too much. And this will provide more problems going this fall because right now it's technically the happy time, summertime, where the virus should not be that strong because most people spend their time outside where it is hard to catch any virus. When we will go back inside and then we have school restarting, well, then we have lots of problems, because even if school is restarting, in some places, some countries, we have in-person classroom, which a lot of people are scared of, to see the virus going up. But if you close your school, you have another problem, because now your parents will not want to work because they have to take care of their kids. So in both ways, it is a very tough decision, and I don't think there's a perfect solution to this as well. There's obviously a little bit more of gloom and doom right now. A lot of people are concerned about central banks because on the one side it's great, they go all in, they will support you, they will issue a bunch of stimulus package, they're buying back bonds on the market to ensure that there's liquid assets. But at the same time, all that money that goes in the market and in people's pocket has to be created from something. And right now it's created from thin air. We're talking about printing money, obviously, because central banks are not literally printing money, but they're creating it electronically. One point in time, that money needs to be paid off, and a lot of people worries, and this is why gold is surging. When debt is cheap, it's cheap for everybody. This means that you have a lot of zombie companies, companies that should not survive right now, that are on life support because they have the ability to still borrow money at a cheap rate, and they're going to do it, and they're just going to delay their bankruptcy or their financial problems. So what we have seen so far in the past 2 months is just the first act of a 2-3 act series. So we're not done yet with the economy going down. This raises other problems such as protectionism. Sorry, it's very hard to say. So protectionism, what is it? Is you want to keep your economy inside your country, so you want to keep everything inside. You don't want to deal with other people. You're going to raise your tariffs. You're going to make sure that you produce all the healthcare products and drugs within your country, and this is bad for the economy in general, because we have been opening up our economy to world trade for several decades now, and now some countries are closing it down, which will obviously rise costs, because it will cost a lot more to manufacture some goods and drugs in the US or in Canada versus doing it in China. So you want to protect your country, but at the same time, you're going to push inflation a little bit higher. A lot of services can't come back, as I've mentioned before. So we're talking about entertainments, restaurant, leisures, travels. All those services will have a hard time to come back in the coming months. We're talking about several years before we see the same traffic in airports that we used to have early in 2020. So basically, the situation is not going to help. A lot of small businesses, low-income families, low-income worker are hurt, because a lot of the services industry, what they do is that they hire people on minimum wages or very low salary, and those are the jobs that are being cut right now. So the unemployment will hurt those people, which will require more support from government. So now that I got you in a gloomy part about my gloom and doom, let's go back to the sunshine and rainbows, where if you had tech stocks in your portfolio, you've been doing well. At DSR, we have suggested our members, we have told them back in March, you know what? One of the safest place where you can put your money is not gold, it's not cash, it's actually technology sector. Those businesses are set to thrive. They were already on a strong trend before COVID-19. Now they're just being pushed. We're just moving ahead maybe like 10 years in the futures in a few months. So companies like Amazon, Microsoft, Apple will continue to thrive. I don't think it's a bubble. I think it's just a lot of great companies sitting on a lot of cash, and their business model is set to thrive when you have to work remotely and when you have to rely on technology to achieve your things, because you cannot do it in person. Lots of capital is available. So I told you it was bad because you have zombie companies that will benefit from that, but you'll also have very great companies that will be able to restructure their debt, do it at a very cheap rate, and make their future project profitable. So I'm thinking about companies like utilities, for example, which is capital intensive. But right now, they have a unique opportunity to borrow money at an incredible cheap rate and then still go ahead with their projects. Because when you think about it, we'll need water, we'll need power. Those things are not going to go away. We need utilities to work in our environment, and they will just do it with lower cost of borrowing, so which is a great thing. And lots of opportunities will rise. They will rise because think about a wildfire. After the wildfire, what will happen is a lot of trees, and then people are going to build up, and then it's going to grow back again and even stronger. So while a lot of restaurants are closing right now, for example, what's happening is a lot of young chefs that have been waiting and desperately dreaming of having their own restaurant will be able to buy those assets next year. They will pay like 20 cents in a dollar for those. They will get cheap loans, and they will likely have a stimulus package to start their own restaurant. So they will start with a great business model, low on debts, low on interest payments, and they will be able to thrive in this new economy. Obviously, it's going to hurt first. We're not done yet with that, but opportunities will rise, and smart people with capital will be able to make a lot of money, as pretty much we saw in any kind of recession. Now it's time to set up your game plan for this fall. And this is exactly what I'm going to discuss in my next webinar on Wednesday the 26th. I'll have obviously discussed that with my members before. But next week I'm hosting a webinar giving you a little bit more insight about earnings, giving you a little bit more about this game plan for either if you're a growth investor like me, meaning that you're in your 30s, your 40s, your 50s, you're not retired yet, and total return matters to you. And if you're retired and you're looking to have a safe portfolio generating enough income, we'll also discuss this game plan. So we'll do like 2 separate game plans for 2 different types of investors. And first, we'll show you what going upstream first mean. This is all about this webinar next week. I'm looking forward to be there with you. The webinar is 100% free, no strings attached. The presentation will be like 45 minutes up to an hour, and then I'll stick around to answer your questions. Replay is available, so if you watch this video and you're late or you can't attend the live webinar, just register, and then you'll still be able to watch the replay, including the questions. So it's 100% free, 100% included in the replay as well. And we usually are a few hundred people. Places are made limited at 500, so make sure that you log in first, because the last few webinars that we had over 1,000 attendees. So some people can't see it live, unfortunately. So make sure that you register fast, and then you open your screen roughly 10 minutes before it starts. So see you there, and until next time, stay invested.